Dzień dobry Państwu. Hi everyone. It's great to be here. Thanks for having me. Um, so let's switch tracks a little bit. So let's switch from fintech to insurtech for the next 10, 15 minutes. I'm gonna tell you about some of the innovative trends I'm seeing in insurance, especially technology-enabled insurance. So quickly about me, I coach soccer. Those are my two most valuable players. And when I don't coach soccer, I either build companies or I invest in companies. And I started in Poland. I built my first company here. Then I moved to Silicon Valley. And now my perspective is skewed towards that market. I spent the last 9 years in insurance. And we insured over 2 million Americans through Get Insured. And now I just started a new company called Gabi. And we're building a digital broker or agent helping consumers make the right decisions about their coverage and about their insurance plans. So insurance is this humongous market with over $4 trillion of premiums written globally between life and non-life products. Yet over the last 10 years, there hasn't been that much innovation as in fintech. So what's really behind it? I mean, the industry is much more conservative. It's more skewed towards not risk-taking by design. Yet over the last 3 years, something started happening. So as you know, innovation requires capital, so let's follow the money for a moment. Well, the venture capital investment went from 130 million just 2011 to over almost $3 billion last year. And even if you exclude the Chinese outlier deal, and they tend to do outlier deals there, it's almost $2 billion of venture capital investment. What's even more interesting is that the money is coming not just from venture capital funds, but also from traditional insurance companies. And the list of insurance companies that started their corporate venture capital funds or invest directly is pretty long, as you can see. And I talked to at least 5 of these companies, and I was surprised with how open they are to investing early stage. Even in a pre-product company, seed stage, Series A company, they really want to have their finger on the pulse and understand what's happening, how people are challenging the industry, and what may happen to them 10 years from now. Obviously, startups started within the last 3 years haven't proved that much yet. It takes 5 to 10 years before the model really is proven that can scale, acquire customers economically. So there's a long way to go to prove that insurtech is here to stay. So I also took a look at value chain throughout insurance, and I said, okay, what are the catalysts behind insurance? Why it started happening just now? Well, there's a range of technologies that really help with innovation, and really that attracts the capital. So on the right-hand side, on the distribution end, there's a number of technologies that try to replace agents or make them much better, help them service customers better. On the product side, there's a lot of innovation around on-demand insurance, so insurance that you can buy instantly, and I'll give you a few examples about it later on. On the underwriting side, big data and smart devices enable very different pricing models for insurance, and there's a nice range of companies actually with a lot of traction in the space. On the back office end, drones and mobile phones help with claims processing, so there's a lot of operational efficiency to be gained from using technology on the back end. And then last but not least, if you look at actual bearing of insurance risk, there's a few companies that do a full stack insurance company. So they actually underwrite risk, sometimes with help of reinsurers at the back end. But they actually go after the full value chain. They focus on everything throughout this complex value chain. Most insurance startups, though, like these, and these are American examples, but actually the European map would be quite similar. There's a lot of activity in Europe. Most of these startups build on top of traditional insurance companies. So they actually don't underwrite risk. They innovate on the front end, on the distribution, customer acquisition side, or product design side. But at the bottom, there's a few companies like Oscar or Clover that actually do a full stack insurance company. And really, I think that Oscar Health started this whole insurance revolution because they proved that they can raise enough money for reserves, that there's enough investor interest to take the risk in a big play in a very conservative industry. So just a few slides on examples of where innovation happens. The first one is location-aware devices. It's driven by smart devices that either, for example, connect to your car, or you may carry them on your wrist as smartwatches. And using smart devices enables new pricing models. So for example, Metro Mile, you can pay a flat fee every month for your car insurance, and then you pay per mile. And that tremendously reduces the cost for anybody who lives in a big city, doesn't drive far to work, and maybe they drive only 5 to 10,000 kilometers a month. And the savings are in the 40% range if you switch to Metro Mile. On the other hand, Progressive, which is traditional large-scale insurance company, started offering discounts based on safety driving habits. So with a device, they know how fast you drive, where you drive, and give you discounts based on that. Health IQ, a much smaller player, they offer discounts if you can run a mile in 8 minutes. So if you can prove with a mobile device, with, let's say, smartwatch, that you are in good shape, they give you discounts, and they price your life insurance premiums in a new way. On the product side, on-demand insurance, so let me start with a few examples. Let's say you're going to London with an expensive camera, you're boarding the plane, and you want to insure your camera right there when you're boarding that plane. Well, on-demand insurance gives you an opportunity to do that. You basically toggle the insurance on your phone, and you buy it right there with micropayment, real-time pricing, and micro-duration of insurance. You don't need to insure that camera for a year or 6 months. You insure it for a weekend. So it's really micro-term insurance, which really had not invested in insurance, had not existed in insurance at all. And there's a number of companies that do it, that apply the concept of on-demand insurance to small electronics, property, rental apartments, or even houses. So the industry is going in a very interesting way. Then, the next space close to my heart right now, because I'm building one of these companies, is the concept of digital agents. With natural language processing technologies, we are able to stimulate smart conversation with an agent, with a bot, effectively a bot that advises consumers on which product to buy. Even if initially we only do 20% of the experience in automated fashion, and it's augmented by human beings behind the scene, it's still the right direction to automate the process to as much as possible. We also use data mining technologies and machine learning technologies to analyze your existing policies, insurance policies, and advise you on which products you may be overpaying for, which risks you may be underinsuring, and we recommend new products in the mix, in a complete view of who you are, what assets you have, and what you should be insuring. So if you have a, let's say, $500,000 house, and you only carry $100,000 of liability insurance, there is a clear disconnect between one and the other. On the back office side, again, I mentioned it briefly before, big data helps a lot with pricing the risk. Web services enable access to big data. Companies like KP Analytics provide a huge database of data about properties, real estate properties, that streamline the underwriting process. At the same time, drones, new sexy technology, help with gathering aerial data about rooftops, about properties, and you can use the data for estimating claims, checking on repairs, and it accelerates the whole claims processing. And one of the last examples, those are big unicorns. At this point, both of these companies are worth over $1 billion, and they are partly related to insurance. What they do is they offer small business software, typically for HR or payroll, but they price it, they offer it as free software, but they price it with insurance commissions. So a small business owner reassigns all of the insurance commissions to these companies, and in exchange, you get free software. So it's a business model innovation that uses insurance as a revenue stream. And what's interesting about it, this business model is actually more effective as cash flow than selling software by itself, and gives them positioning around free software product. So just to summarize, I think insurance is really the next wave of fintech. It started much later. It's going to take much longer to prove that it makes sense. It's, in a way, more complex than most banking services or financial services. But the opportunity is certainly there, and I'm excited to be part of it. And I'm watching both European markets and developments there and the US market really closely, because I think we're just scratching the surface of what's possible in the space. Thank you so much.